Good morning. We are half an hour away from the open. Hong Kong, Shanghai, and Shenzhen. You're watching the China Show. I'm David Ingles with Rebecca Choong Wilkins.
Our top stories this morning. Asian stocks gaining after US inflation data came in lower than forecast, helping Wall Street rebound from 2 days of heavy losses.
Now, Trump's trade policies, though, are still injecting a lot of uncertainty into these markets, with the US president promising to respond to Europe's counter-tariffs. That's after his own duties on metals did just take effect.
Also ahead, Walmart is facing scrutiny in China over reports it asked local suppliers to bear rising costs from US tariffs.
And Alibaba's in focus this hour with a new AI model that it says can read emotions, taking on OpenAI. Good morning. And yes, increasingly with these new AI models being able to read emotions in the room, incrementally perhaps we're losing a little bit of our significance here in terms of being able to give you the mood of these markets right now. I can show you color though for now. Color is roughly green, as you can see on your screen. The dollar is softer. A lot of the markets that have been up and running are seeing a bit of a bounce back today. Taiwan, of course, is very much in focus, given, of course, the Intel story. And a lot of the semiconductor names in Korea and Japan have actually seen some decent gains this morning in about the first hour of the session. TSMC, as you can see, 1.2%. One market that is in focus as well is Malaysia. It did enter into a technical correction yesterday. One of the worst days in months, down over 2.5% for that specific market. In fact, just on that very note, right, when you talk about Taiwan and so this one is actually very close as well to entering a correction. And in fact, we are seeing a record streak of foreign selling coming out of the Taiwanese market, right? A lot of the crowded trades, right? We've seen a story of that sort when you look at the Mag 7 and just getting forced out of those positions, right? So just very, very quickly, right? We're taking a step back. Where are we as far as this sort of, we focus on this China rally a lot, but there are a lot of markets that are actually struggling, right? Either we're near correction on these, we are in a correction from these markets, and in a bear market, in fact, across some parts of Southeast Asia. Talk more about this a bit later on the show. Very quickly, how did we do overnight? A decline, a pullback, a consolidation, if you could call it that, on many of these Chinese, well, U.S.-listed Chinese companies. We talked about Alibaba and, of course, that new AI model that can read emotions. The big event today is in Hangzhou and an AI summit, which we'll get you a preview of a bit later on in the show. And maybe what that means for the broader sort of AI conversation here. A50 futures, Singapore, Hong Kong. You have the Hong Kong dollar in focus as well, given just the amount of money coming through that stock connect. Yesterday was the second biggest amount on record. We're trading at about the strongest level here on the Hong Kong dollar against the US dollar on record. And the pullback we've seen off that 1.9% handle on the 10-year yield. So certainly it is something we'll continue to track today. Rebecca.
Yeah, absolutely. Just picking up on that theme of southbound flows, that really this big question when it comes to these robust flows, to what extent do we start to see international long-only, US long-only firms finally being willing to re-enter this market? Of course, those southbound flows have really held up a lot of the momentum that we've seen in Hang Seng Index, one of the, if not in fact the best performing index in the first 50 days of Trump, since Trump became president. A sort of extraordinary shift in circumstances from where we were. Elsewhere, we're also keeping an eye on those CGB yields. Of course, we had the 10-year just flirting with that 2% level that we watch so closely. And it's really all about this concern on whether or not the PBOC is going to yield and introduce more monetary support, introduce a little bit more supply to come into that market as well. A lot of data is coming through. Keep an eye out. Hong Kong industrial production, PPI data. And then on the China side, we are now in the window for credit data as well as FDI. Elsewhere, big Hong Kong name, Swire earnings coming up. And, of course, we have this summit in Hangzhou, organised by the Hangzhou government. We have the likes of Huawei, Alibaba attending there today. Yeah, and I mean, really a big part of that story that we've seen, of course, has been focused on this renewed belief that China can innovate, that we will see more sort of similar innovation, similar to DeepSeek, Manus, and so on.
Yeah. I mean, if you think about it, really Hangzhou is at the center of this, really, where you have like some DeepSeek, for example, and of course, to your point, right, Alibaba. So we'll see what happens, and really, if any news comes out of that conference taking place in Hangzhou today. Just to pivot back as well, and why we are seeing a lot of green on our screens right now, really one of the few bright spots for this U.S. equity market was that soft inflation print overnight. I think the question for markets, and as you can see, that came in softer than expectations just about across the board. And the question for markets is this a snapshot in time of the past? And is it very hard to take the data that's come through and extrapolate that, given how many parts of the U.S. inflation basket are susceptible, really, to all the tariffs and the policies as well? In fact, that's the point coming through out of Anna Wong, out of her Bloomberg economics team, that ultimately it really will depend on what the Trump policies will be and how that really feeds into the sort of the broader parts of this U.S. inflation basket.
Yeah, that's right. I mean, the whole issue is to what extent this predates a lot of the tariff stress that we've already seen, as well as this question mark over recession risk. We've gone so quickly from talking about this U.S. exceptionalist story to the recession risk story. Again, how does CPI play into that? Yeah, well, let's put that question right now to Danielle DiMartino Booth, CEO and Chief Strategist at QI Research. Danielle, thank you so much for joining us. Good morning from the Asia Pacific. Two-part question. I'll use the same term, though, useful. How useful was that CPI print last night to tell us about what's happened and also to tell us what's ahead?
So I actually think it was a very useful report. This is the first decline that we've seen in 6 months. We know from a lot of sentiment surveys that American households have been buying ahead in anticipation of the tariffs and paying up to do so. That appears to have come off of the boil. Anna Wong today in her analysis pointed out that it is services disinflation that is beginning to filter through to the data, and that could be a reflection of the other Trump policies that are indeed introducing recession into the discussion, because we are starting to see a lot of the fallout from layoffs accelerating, bankruptcies accelerating in 2025, and how that is affecting the purchasing power of U.S. households. I think one of the greater risks today is that there's going to be a margin squeeze for companies that have to shoulder the cost of tariffs, but are not then able to pass those costs through to the end consumer.
I want to pick up on your point there about some of these pain points that we are seeing. When are we actually going to start seeing that show through markets? And in the terms of the data, what are the metrics that we should be looking out for now?
So I think that with the earnings falling in the gig economy, with the unusual explosion that we've seen in Americans dropping out of the labor force, giving up on work, the shrinkage of the work week, meaning weekly paychecks on an inflation-adjusted basis have actually been falling since last September. I think the pain points that we need to be looking for are increases in jobless claims. And that is indeed what we are anticipating, as well as Bloomberg's economics team, is that we are going to start to see this filter through to the more frequent weekly data that we're seeing on the labor market here in the United States.
So put that to us in simple English. Is the economy slowing or not?
I think we know with unequivocally that the U.S. economy is slowing. For the last year or so, we've only been talking about goods spending slowing, but in the most recent personal spending report, we saw services spending flatline. We've seen major downside in hotel rates, airfares, discretionary type of categories that are telling you that U.S. households are under extreme stress, and we're also seeing that flow through into the delinquency data that's the highest since the financial crisis.
When we think about some of these tariff threats, to what extent are the levels that we have now somewhat tolerable? And at what point do we kind of cross that line? What are the sort of tariff levels? What is the sort of trade war that would really push the U.S. into recession?
So I don't really think it's going to take very much to filter back through to corporate margins at all. I think the United States is either in recession or on the brink of falling into recession. U.S. automakers have been very vocal about how dangerous this would be to production, that it would filter through into layoffs. that would be piling on to the enormous increase that we've seen in job cuts in the public sector as a result of Elon Musk and his Department of Government Efficiency really using that chainsaw that he was filmed using, but using it on the U.S. public workforce. That was one of the areas of the biggest strength in the U.S. economy over the last 18 months that was offsetting private sector job losses.
So Danielle, I think just to build on Rebecca's question just now, is there a perceived amount of future economic pain that you think, I'm thinking about the offsets here. Well, for one, that you think Donald Trump then pulls back from some of these policies? In other words, is a pragmatic Donald Trump, say, in the event that it needs to be pragmatic, does he pull back? And at what point does the Fed come in and say, we will be the offset?
So I certainly do think that there is a hope that Donald Trump is going to act as he did in his first term. But from what we've seen in these first 50 days, he seems very intent and serious about pressing forward with these tariffs that we know will push the economy over the edge and into recession. I do, to answer your second question, believe that the Federal Reserve is going to be responsive to the damage that is unfolding in the labor force. Last Friday, Jay Powell was interviewed, and he said that if he did see evidence of further weakening in the U.S. job market, that the Fed would indeed be responsive to that. So I would expect that we would see a continuation of increased expectations for more Federal Reserve rate cuts, more Federal Reserve easing in 2025.
Danielle, just quickly here, can I ask, how is China playing into your thinking on all of this, given that so far they've been relatively moderate in their response and in their retaliation?
Well, and I think that that is the big focus here, because if you look at some of the areas where the United States is being the most forceful with tariffs, indirectly, they really are aimed at China and the Chinese industrial juggernaut. So I would suspect that with Canadian retaliation, now we're hearing from the Europeans as well, that we will start to hear more than just low rumblings coming out of China if this tariff trade war is to escalate further. I doubt that we're going to hear so much quiet going forward.
Okay, Danielle, thank you so much for joining us, and in fact, at a late hour your end as well. That's Danielle DiMartino Booth, CEO and Chief Strategist at QI Research. Still ahead, why BMI thinks gold could outperform this year amid trade tensions and geopolitical tensions. That interview is coming right up. And we are counting down to the open of trade in Shanghai, Shenzhen and Hong Kong. Good morning, you're watching The China Show. Good morning. You're watching The China Show. Now, President Trump says the U.S. will respond to the European Union's countermeasures against his metal tariffs, raising the risk of further escalation in his global trade war. Bloomberg News Desk editor Jill Desis is with us now. We have a countermeasure to countermeasure. We're sort of trapped now, perhaps, in this spiral of responses. Explain the very latest and the risks.
Yes, well, I think, you're looking at a pretty substantial risk here, particularly with these latest EU countermeasures, because as we've seen, a lot of other allies that have really been, in other nations that have really been swept up in this trade war and these escalating tariffs have kind of sat there and said, we're still weighing what negotiations ultimately look like. I think particularly when you look at a lot of the Asia-Pacific region, Australia, which of course, despite pleading for exemptions, didn't get anything from the United States. The UK has also said, we're going to kind of sit down and weigh our options. Even Mexico, which has really been the target of some of the most substantial tariffs here, is still kind of in a little bit of a wait-and-see mode. But when it comes to both Canada and then now the EU, you look at these latest EU measures and you're looking at something that affects some 26 billion euros worth of U.S. goods. We're talking nearly 30 billion U.S. dollars worth of goods here. So it's really the EU and, to a certain extent, Canada that have come out here and kind of matched Trump's tariffs, sort of like for like here. So you're not looking at very measured responses there. Obviously, the EU Commissioner, Ursula von der Leyen, coming out and saying, look, we deeply regret this, but ultimately this is kind of what we have to do. So, and now with Trump's response here, I think that really does kind of show that, especially ahead of that April 2nd deadline for more tariffs here, we're kind of getting trapped in this escalating sort of situation.
Yeah, I'm sure we'll be seeing you plenty more this week. That's Bloomberg news desk editor Jill Deese is there. Now, a quick look at what's making headlines in Chinese media. Xinhua News Agency has published this piece on some of the economic pressures facing the EU, really sort of spotlighting some of those anxieties that we're seeing in the EU, prospects of a recession due to some of those trade policies from Trump. The article quotes US economists and analysts saying that there is this growing skepticism about the tariff policies, pointing out their, quote, remarkable volatility, often with flip-flops within weeks, even days. Of course, this idea of sort of flip-flopping is so antithetical to how policy making happens in Beijing.
Yeah, it's an interesting juxtaposition. That's level number one. And level number two is, today we're talking about they're putting the two economies together and they're comparing them. And yesterday, when we had a look at state media, for example, they were comparing the sustainability of the U.S. equity market against where you are with China, right? So you really see the framing taking place with the economy, with the policy-making structure and the confusion sometimes that comes out of Washington, the lack of it so far in Beijing, and the equity market too.
Yeah, and really worth noting here that even as we say this very sort of surgical, precise approach to and responding to Trump's policymakers from Beijing itself, that against that backdrop, we have this quite robust media narrative that very much is still pitching the US versus the Chinese economy against one another.
Yeah, well, the news flow is giving them a lot to chew on, really. I mean, Trumpcession, for example, you see that on your screens, right? So it's massively trending right now on Weibo today, with some, in fact, saying that the U.S. is only facing a small correction, while others think Trump's main goal is actually to force the Fed to cut interest rates. In fact, state media, just on that very note as well here, has been playing up U.S. economic, and to our point earlier on, market headwinds, right? Earlier this week, the Global Times published this editorial, this cartoon on the U.S. market, citing tariffs as what it calls the black cloud over Wall Street.
Yeah, and to your point about tariffs, we've also seen now China summoning Walmart after the U.S. retailer reportedly urged its mainland suppliers to absorb the cost of those higher duties. Our chief North Asia correspondent, Stephen Engel, joins us from Beijing now. Steve, tell us, what do we know about Walmart's business in China?
Well, this particular case could cause some severe brand equity problems in China. Obviously, we know that state media in the past regularly has used these, consumer watchdog segments to kind of call out what they perceive to be bad behavior by foreign companies in China if there's a geopolitical reason behind that. Oftentimes it's if a company or a brand uses derogatory terminology or allegedly does against China, and then there's a subsequent boycott, and then the internet in China kind of goes, crazy, condemning these brands. Now, this is a position Walmart does not want to be in because they are also a global, multinational company based, of course, in the United States, but 60% or thereabouts of their goods globally are sourced from China. Now, the story is, Bloomberg first reported it last week, from sources that they were allegedly asking their China suppliers to cut prices so they can absorb better when they sell their things back in America the Trump tariffs of upwards of 20% now because of the fentanyl issue. Now, the latest story, there was a press conference yesterday from the Ministry of Foreign Affairs, as well as, well, let me see, who was it? It was the Commerce Ministry, not the Ministry of Foreign Affairs, as well as other individuals basically saying that they've summoned Walmart executives over a report it asked suppliers to bear the rising costs of those tariffs in the United States. And according to Weibo Post, affiliated with state media CCTV, which of course regularly signals Beijing's trade intentions, the Post demands the risks, or basically says these demands by Walmart, if they are true, risk fracturing the global supply chain and hurting the interests of both U.S. and Chinese companies. Also hinted that Walmart could expect more actions from Beijing if it continues this practice. Here's some quotes. I was talking earlier about the blowback or the potential blowback from consumers. There's been a number of them, most of them anti-Walmart. It's just a supermarket, shut them down directly. Chinese suppliers must get pricing power and cannot be exploited all the time is another one. Suppliers must unite and not succumb to threats. We should all move forward or retreat together. And another one, companies like Walmart are too reckless and deserve punishment. There was one that we saw that was more pro-business. Essentially, what's wrong with that as far as lowering the prices that they, or the costs associated with their suppliers? What's wrong with that? Walmart is acting in its best interest. So you can see there's a lot of, I wouldn't say necessarily a firestorm yet, but as this story grows, you have to also watch other hypermart operators like Costco. I'm not saying they're being targeted at all, but there are a number of different retailers, multinational retailers in this market that are kind of watching the Weibo streams right now.
Well, I mean, you can almost guarantee that the PR team at those firms are looking at this already in that event. Steve, that's a good point. Steve, yesterday we had a briefing, of course, the foreign minister briefing. I want to touch on one of the things that they mentioned yesterday because the fentanyl issue came up, and what was China's response to that?
Well, fentanyl issue has been the core, of course, of these 20% added tariffs. First 10, then 20%, because the Trump administration claims China is not doing enough to counter the chemical production and precursors that are allegedly sent to Mexico and then on to the United States. China has consistently countered that assertion, saying China has done, and this is the latest statement yesterday from the Ministry of Foreign Affairs and the Ministry of Public Security, saying they have done all they can to forcefully crack down on the fentanyl trade and has essentially the United States, they're saying, is using fentanyl issue as a pretext to raise tariffs. Wang Yi, the foreign minister you see here last Friday, he called the U.S. position on fentanyl two-faced. This latest press conference yesterday in Beijing, went as far as to say that Beijing has done America a favor and should have sent a big thank you to the United States for what it has done so far on the fentanyl issue.
No, 很感谢, right? Okay, Stephen Engel, thank you so much. Our Chief North Asia correspondent there in Beijing for us. Right, just going into the Open today, 6 minutes away. A preview on your screens, a fuller one just ahead. This is Bloomberg. Right, welcome back to the program. Just a brief look at the pre-markets right now. So we are slightly higher on these benchmarks. Just keep in mind, right, some strength in the Hong Kong dollar, a lot of money coming through the Stock Connect, second most daily net amount coming through the Stock Connect yesterday, and we'll see what happens with that today. We are in the window, flip the boards please, we are in the window for the credit numbers to come through today, so we'll get you a preview of that. Li Auto, bottom of your screens, is up 3%. HSBC put out a lot of upgrades on these auto stocks. They join us in the shows later on. The Open is next. This is Bloomberg.
Good morning and welcome back. You're watching The China Show. We are counting down to the open of markets, about 40 seconds and change there away. And we're opening relatively muted, although we did have a bit of a boost after the US data came in a little bit stronger than expected, Dave.
Yeah, and I think it's a good time to take stock, right? So that really was, I think, one of the exceptions to what's generally been a negative year for US equities. The last, I had to look at some of the charts. The last, I would say, 8 to 10 sessions have been, when you look at the U.S. markets, obviously more to the downside. The cohort of Chinese equities in the U.S. have seen, we've been hitting our head on this 8,000 level on the Golden Dragon Index. So we've yet to fully breach that sustainably, and I think you can make the same case when you look at the benchmarks in Hong Kong, where yes, we are back at 23, 24 on the Hang Seng. But the last few days have really seen us consolidate around these round numbers. On the Hang Seng Index, in fact, we'll get you a briefing on that later on. We're actually now about to test, and this is extremely long term, about to test the 1 100-month moving up to the upside for the first time, I believe, in about 2 or 3 years, right? So it's taken a while to turn the ship around. All that being said, it's just a way of saying nothing is really happening in these markets. there we go.
So far.
So far. The night is young. What's interesting, too, is we have a fantastic story out on what this world-beating rally in Hong Kong is really posing as an alternative to Wall Street, right? And part of the math that we're doing in that story is that for the first time, I believe, in, I would say, 1 or 2 years, the 90-day correlation between MSCI China, which is the thing bottom of your screens, and S&P has now turned negative, right? So it, in fact, is now there. They're behaving differently, the two benchmarks. That comes amidst, flip the boards, please, the broader cohort of Asian equity benchmarks, whether that's Australia, Taiwan, you have Southeast Asia, are either in a correction, near a correction, or in a bear market. But again, this has really been the sort of anchor to equity returns so far this year. It's Hong Kong, and it's also in Europe. Right. HSBC on your screens. We'll talk about this later. Interesting story coming out there. Alibaba, okay, is out with an AI model that can read emotions in this challenge here to OpenAI. That takes us into the other thing we're talking about today, this AI summit to be held in Hangzhou on Thursday. Very briefly, let's have a look at some movers here. Cathay Pacific out with earnings almost 24 hours back, although we are still getting a lot of analysts coming through with their updated rating on the stock. What we've seen so far is HSBC cutting that to reduce, and JP Morgan cutting Cathay to neutral. I should mention Cathay is still up some 40% from the bottom of last year, so that is perhaps more a function of the stock move than it is perhaps the earnings. Right. Meitu, crypto is back. I think Bitcoin, for example, is back above 80,000, hence getting a rebound there. XPeng, massive move up overnight. And it's interesting because HSBC, speaking of their sales side here, Yuqian, who covers autos for them, will be coming on in about 60 minutes. So they've upgraded their price targets for many of these Chinese EV players, whether that's as a function of the business, the stock price, lower beta, in some cases, lower premiums, for example. So XPeng is, and Li Auto actually is one that stands out to them as well. We'll understand better, of course, in about an hour from now. Right. Speaking of earnings, you have BOC Aviation, Guangzhou Pharma, Swire is also coming out with earnings today, and just a lot of corporate news today. And, you know, this one on New World, Rebecca, is also something that's very, very interesting.
Yeah, it's an interesting one that's caught my eye. I mean, I've had this question for a long time, which is when does New World Development debt become a really big distress play for Hong Kong, and particularly for Hong Kong? It's been relatively hard to play some of those mainland names just because those restructurings have taken so long. The refinancing has been so challenging. So this is a very, very different kind of proposition. We now have sources telling Bloomberg that Ares Management approached at least 2 banks in February about potentially buying some of this debt. We have to assume at some kind of discount.
Yeah, otherwise, why are we talking?
Yeah.
Right, is the point. Speaking of restructuring, the story that caught my eye, I talked about HSBC earlier on, is, you know, of course, they are in the middle of restructuring. And we understand, based on some of our sources here, that the bank has actually placed several bankers on what appear to be 3 to 6 month work arrangements to, I guess, wrap up some of their business and outstandings, of course, in places where those restructurings are taking place, like Europe, Asia, Americas. And the plan also includes slashing many of the vice chair roles in various markets. That's according to those same sources. It's not clear, though, how many bankers are actually affected by these latest moves. And yeah, so we are moving very, very close now to that massive summit that they're holding here in Hong Kong. So certainly interesting conversations are about to pop up there. So guaranteed.
Yeah, a lot of people in a lot of rooms and a lot of talk about, I would say, over the next few days.
The room will not be big enough.
Yeah.
We'll see.
All right, shifting gears now to think about tariffs, commodities. Canada and the European Union have both responded with retaliatory measures against President Trump's 25% tariffs on steel and aluminium. Those took effect on Wednesday without any exemptions. Joining us now is Sabrin Chowdhury, Global Head of Commodities Analysis at Country Risk and Industry Analysis provider BMI. Let's just begin, I think, because we do have a little bit of a precedent here from President Trump's first term. I suppose I want to ask, this time around, Trump 2.0, how much more painful is this all for commodities?
So reminiscent of Trump 1.0, commodity prices are very elevated at the moment. Metal prices especially have outperformed the entire commodities complex. Metal prices in the US have spiked significantly. The spread between global prices and American prices have expanded significantly as well. So just like before, Trump 2.0 tariffs are likely to boost metal prices in the short term, but going forward in the latter half of the year, we do expect some weakening.
Yeah, just to follow up on that, David here, by the way, should we expect that spread between, say, the pricing we're seeing the spotted oil, particularly in China, and the spread, to your point, that we're seeing in the U.S., should we expect it to remain wide, if not wide, in short term?
So definitely wide in the short term, very wide. It will be wider in the next 2 to 3 months when the full impact of the tariffs is felt by the market. But going forward, global demand remains weak like last year. We do not expect a significant pickup in demand from mainland China, which is the major consumer of most metals. So going forward, the spread should narrow down.
Yeah, right. And before we talk about the China part, because there's a lot of other issues there, can I just ask you a final one on the spread? Is there any particular metal that stands out to you that might see their spreads widen more than the others?
So that would definitely be steel. Steel prices in mainland China as well as in emerging markets, prices aren't doing very well, especially because the demand from China is, I mean, I have to speak about China. The mainland Chinese property sector is the main consumer of metals. So as the property sector remains in the doldrums, the demand for metals, for steel especially, is set to remain weak. On the other hand, in the US, prices of steel will go even higher because of the tariffs. So because of that, we do expect steel prices globally to underperform US prices more significantly than other metals.
I mean, following up on that China story, so food has been a key target in terms of how Beijing has chosen to respond to some of those US tariffs. How is that impacting agricultural commodities? What's your outlook there?
So to be honest, agricultural commodity prices have weakened significantly this year. They're one of the underperforming commodity asset classes within the wider commodities complex. And this is mainly because of fundamental factors, not the tariffs. Fundamentally speaking, supply for most agricultural commodities has been really strong this year due to better weather and other idiosyncratic issues. So prices have been muted. There hasn't been much growth. In fact, there has been declines. So we do not expect much of an impact due to the tariffs. At the same time, mainland China's strategic diversification of agricultural commodity imports means that the impact of these tariffs on US imports will be very mitigated.
Yeah, well, I'm curious now, before I pivot back to sort of the geopolitical angle here, and the supply curves, by the way, which I want to ask you about in a moment here. Can I ask you one last thing on agriculture? Do you cover coffee by any chance? Because we have seen coffee prices just go through the roof, and I'm wondering if you have any insights on that.
Yeah, so coffee prices have outperformed the rest of the complex. It's also due to supply issues. But at the same time, if you look at cocoa, that's a total opposite to coffee prices, because the sentiment towards demand for cocoa is really weak due to a global slowdown. So coffee will definitely be one of the outperformers. But if you look at grains or other soft commodities, everything is really on the decline.
Okay, final question for you, and I'm sorry to just circle back here, because the tariff story is playing out in the form of, and I think what we had from the NPC, for example, and some of the officials and the pronouncements there, is that China seems to be embarking on perhaps what seems to be a new round of supply-side reforms around steel capacity in certain provinces, and I'm wondering what you're seeing from your end.
So in terms of steel capacity supply-side issues, we have seen these supply side reforms before. In such instance, previously, what happened is lower cost, inefficient, smaller producers would leave the market. The steel sector would be consolidated around the main SOEs, the large SOEs. But then again, steel production in China has declined last year as well. They already have been on a declining path. So we do expect a little bit of a decline in Chinese steel production this year. But at the same time, we also do expect, like I said before, a decline in consumption as well. So the outlook for steel prices is downbeat.
Can I ask you about gold? Does that continue to
why not?
provide these returns? I know you like gold.
Yeah, I love gold. So we're really bullish towards gold. Gold prices are likely to hit $3,200 an ounce in the coming weeks, if not 1 month or 2 months. Gold has benefited from geopolitical tensions since 2023 at least. And gold as a safe haven asset will continue to outperform. Now, gold has hovered around historic highs right now because of trade uncertainties, as well as falling yields, and obviously the weaker US dollar. Now, traditionally, when tariffs were slapped on other trading partners by the US dollar strengthened, but this time it's weakened. So everything looks really positive for gold.
Sabrin, thank you so much for joining us. That was Sabrin Chowdhury, Global Head of Commodities Analysis at BMI. There's plenty more ahead. You're watching The China Show. This is Bloomberg.
Right, welcome back to shows. So something to watch before you go into the weekend are these nuclear talks that China will be hosting with Iran and Russia that takes place on Friday in Beijing. And the summit comes after President Trump urging Tehran to negotiate a new deal over its atomic work or face military action. Let's bring in John Liu, our Greater China executive editor, with the details for us. He joins us from the capital today. Yeah, John, so what's on the table tomorrow, and just give us broader context really on this specific meeting that's taking place.
So we will have the deputy foreign ministers from Russia, Iran, and China meeting on Friday here in Beijing. As you said, this comes after President Trump has signaled he wants a new deal with Iran. He has sent a letter. That letter has been delivered to Iran. There were also reports that he had asked President Putin to help broker a deal with Iran. And of course, China is an important supporter for both Iran and Russia. After about a week after President Trump had that call with President Putin then discussed everything that's been going on with President Xi. And so this meeting, this confab in Beijing, it really underlines what looks like an effort for Russia, Iran, and China to be on the same page when it comes to negotiations with the U.S., be it on Ukraine or be it the Iranian nuclear program.
John, the role of China playing host here to this meeting is really just the latest in an example where Beijing has tried to project itself as a global statesman, a figure that's able to help with kind of be a neutral mediator for some of these tough, difficult deals. Can you give us some context on to what extent President Trump's presidency is allowing China to take up that role? Is it providing more opportunities, or are we seeing Beijing shifting or advancing that effort?
Well, as we heard from Chinese Foreign Minister Wang Yi at his briefing last week, he wants to present China, I think President Xi wants to present China as a bastion of stability in a sea of chaos caused by the United States, caused by the Trump administration. And so this is part and parcel of that. China has had a recent history of playing a mediation role. Of course, they mediated the resumption of normal diplomatic ties between Iran and Saudi Arabia. They've been trying to play a role or offering to play a role in the talks over the war in Ukraine. And so I think there is an opportunity, and I think Beijing sees it very clearly, for China to improve its standing in the world, to increase its trading partnerships, its diplomatic relationships, because the United States, through its own actions, has alienated so many of its allies.
Okay, Bloomberg's Greater China Executive Editor there, John Liu. Now, to some of the other political stories that we are following this morning. U.S. Senate Democratic leader Chuck Schumer says his party would block a Republican spending bill to avert a government shutdown on Saturday. He urged the GOP to accept a Democratic plan to provide a month of interim funding instead. Schumer's declaration heightens the risk of a government shutdown at a time when financial markets are hypersensitive to new disruption. The U.S. Federal Trade Commission is said to be moving ahead with an antitrust investigation of Microsoft that was opened in the waning days of the Biden administration. The agency is also scrutinizing Microsoft's decision to slash funding on its own AI projects after a deal with OpenAI. The move suggests Donald Trump's new FTC chair will also prioritize the scrutiny of tech giants. There's plenty more ahead. You're watching The China Show. This is Bloomberg.
Yep, it's one of those days where, okay, let's be creative here. S&P futures are gaining as traders brush off risk trade war concerns. NASDAQ futures, though, are down as traders and concerns over a trade war come back into focus.
It's a perfect headline, Dave.
Right?
All in
almost,
one.
It's almost AI. We're trying to remain relevant here in our amidst all these new breakthroughs in the tech space.
But in some ways, you're absolutely right. Like, we had this instant knee-jerk reaction, yes, this is positive news, but then we had this immediate recalibration because it was almost as if markets sort of were like, yeah, but what's next, right?
Yes.
Actually, tariffs are still incoming. Actually, this really sort of predates tariffs and so on and so forth. So we had that big snap.
Yeah, from U.S. inflation and then this, the potential response to the European response to tariffs, right? So, just to take you back to the point in time, this moderation in U.S. inflation, for example, was really driven in part by, for one, drop in car and gas prices. Now, we spoke with Mohamed El-Erian, Bloomberg opinion columnist. He explains why, despite the cooler data, consumers are actually adopting, as we were just pointing out there, a wait-and-see approach.
So if you talk to economists, they'll tell you looking back, it's good news. Looking forward, there's very little information content. Because of what David just said, what we've been discussing all day, is we don't know what the pass-through of expected and actual tariffs will be. So that's why the economists are. For those in the market, having been disappointed on the Trump put, this is better news on the Fed put. And I think that's why you're getting such a strong reaction on the equity side.
There's been so much confusion, Mohamed, about tariffs in the past 24 hours or so. You wear several hats, one of which is you've been a business leader for many, many years. And I think you made the important distinction when we had the boom of inflation. You made the point that this was not going to be transitory because of what you saw at the corporate level, how companies were acting and how they were responding. Given the threat of higher tariffs still to come, what do you see now from companies? And what does it indicate to you about what data might look like in months and quarters to come?
So two things are obvious to me, John. One is that companies have gone into a wait-and-see attitude, and understandably so, especially if you're a multinational. You need clarity. So you're postponing decisions because you don't want to make a decision that ends up being a big mistake because the world has changed on you. So we are seeing business activity slow down. The second thing we're seeing is people are much more ready to pull the trigger on price increases than they were in 2021, 2022. So if these tariffs stick, and if we get more tit-for-tat trade issues and things like that, then the pass-through to prices will be quick. And it will come at a time when demand is softening. So then you bring the third issue, which is the consumer. The consumer is hesitant already. I take seriously what you've been saying, all of you saying about what's happening to airlines, what you're hearing from different retailers. There's been risk aversion clarity on the sense of the household. So put all that together, John, it is a wait-and-see economy that cannot absorb much of a price hit.
There we go. That was Mohamed El-Erian, president of the Queen's College in Cambridge, and of course, Bloomberg opinion columnist, speaking with John Ferry, of course, there. Fantastic conversation. Really on the back of this inflation report, what it means, how informative the set was. As far as the Bloomberg economics is concerned, and Anna Wong and her team have actually crunched numbers, and effectively what they're saying is ultimately the impact will really depend on what lies ahead in terms of whether or not this inflation trend continues. Bottom line, change the page, is that they still expect the Fed to take rates down by 75 basis points this year. Bottom of your screens, 10-year yield, 4.3%. Right. Also, maybe coming in and just borrow that analogy of rates gliding lower as well. Back on the runway, our shares of Cathay Pacific, 42% from the bottom, down 5% post-earnings. The earnings beat, the cargo outlook, as we were just pointing out, their bottom is unclear. What analysts have done is mostly from what we've seen so far, HSBC and JP Morgan have both come out and basically reduced and cut their outlook for the stock specifically to reduce at HSBC and to neutral at JP Morgan. Right. Do you feel love? Are you the type, of course, that is has an EQ of 0.5? Well, look no further. Alibaba's new AI model might be able to plug that emotional gap.
Yeah, said to be able to read emotions. I feel like every day on this show we're just getting closer to replacing ourselves.
Yes, I know. And we're watching and we're telling the story until the day comes.
The story of our own demise.
Well, speaking of demise, volumes are actually down to the downside right now. 50% lower than usual. First 30 minutes of trade. Plenty more ahead here on The China Show. Good morning. All right, we are struggling a little bit here to determine what narratives to attach to this.
Going to lay it all out on the table.
I'm just going to read it out, really. You can't go wrong. So we're down 0.41% on the Hang Seng Index. What's interesting, and we're down 1.27%. Thank you so much for my producers for giving me slightly more to chew on here. Volumes are interesting, right? So I think to the point we were making here that nothing is happening today, it's entering a period of consolidation. Volumes are about 50% lighter than usual on the Hang Seng Index for this time of the day. And if you extrapolate what the current number gives you at the end of today's session, potentially, we could get something south of a 2.2 billion share volume, which would actually put us to the thinnest trading volume day of the year so far.
Yeah, that's a really good point, and I want to pick up on that thread here, because it does feel like this week in particular, it's every day sort of been an all-or-nothing day, right? Think about yesterday, we had southbound flows, second highest on record. The day before, we were sort of talking that we were really surprised. After that really robust start, we then saw a bit of sluggishness, a lot of those flows kind of erased, essentially. So it does feel like we're going through this odd period of whiplash almost.
Yeah, and what time is it? It's 10 a.m. in Asia time in Hong Kong. So, I mean, the day is early, so it could be one of those all-and-nothing days at some point. So we'll see what the news flow looks like here going into the session today. What's interesting when you look at the benchmark, so we're down there, right? So the big story overnight is Intel and the changes there. And, in fact, if you draw the news flow all the way back from yesterday, too, is, yeah, you have TSMC down in the mix, right? And what any potential JV might look like and who owns what and who controls what. We are getting at least something to talk about as far as the chip-related sector is concerned. Advantest, as you can see, up 6%. The other story which actually is behaving itself today was, so you had this massive melt-up in CGB yields, which actually took the 30-year to above 2%. Last we checked, we still are above 2%, but we are about, if this continues to breach out to the downside, although, right, if we get to 2% on the 10-year, that's something to talk about, too, on the back of, I think, something we were talking about, the lack so far of stimulus coming out of the PBOC that they've told us is coming.
Yeah, I mean, we've been waiting for months, in fact, that, you know, since last year, we've been expecting, after we had this big shift in the language, looser monetary policy. That was the big indication. But since then, we've really steered back from that. We've been having this sort of continuous, quite hawkish commentary from the PBOC, just warning markets it's not ready yet.
Yeah, you have to keep the currency stable, I think, is the indirect result of that. And you do understand with the changing conversations around tariffs, right? So you look at the euro here, which is top row, rightmost side, coming through big news yesterday out of Europe. So they're coming out with a countermeasure. And then Donald Trump overnight basically said, I am ready to respond to whatever Europe comes out with as well. And here we are, right? So we're slightly higher in price, but there's no volume coming through across these markets. Let's bring in Mark Cranfield right now. Give us more context here out of our MLive team. Mark, it's been a tumultuous year so far. We need quiet days every now and then, and we're getting one right now.
Well, as Rebecca was talking there about whiplash, and obviously that's what traders and investors are feeling. And Bloomberg's running a big story today, actually, that Brevan Howard, one of the biggest hedge funds in the world, is slashing traders' risk-taking abilities because the firm has not had a very good start to the year. So when you see that a major hedge fund, and they're unlikely to be the only one because they often, the multi-strategy type funds are often doing the same kind of things in the market. So if major hedge funds are having difficulty with these kind of markets, which are very much up their street, these are macro moves. The trouble is sometimes they're just too fast and too repetitive. So that means that even very seasoned people are really struggling to make sense of what is going on and to make money out of it. Now, if you've got major hedge funds pulling back on their risk-taking, you're bound to get days like today where people just don't want to get involved because they're still hurting from some of the pain that's been inflicted on them in previous weeks. Also, our colleagues in New York overnight ran a very interesting piece about the word uncertainty. If you look on the Bloomberg terminal, the searches for that word are at the highest they've been for the past 4 years. So clearly there's a lot of people out there who really don't know what to make of it. So after you'll get forced in the market to do things probably that you get forced to do hedges, you get forced to take off position when you really don't have a high conviction about it, you're bound to get a pullback. So yes, it wouldn't be at all surprised if today turns out to be a relatively low volume day in Hong Kong, but probably around the world, because people just want to take a break and try to sit back and say, what on earth is going on here? How do I plan for the months ahead?
Mark, shifting focus here, I want to ask about Japan too. We did have some commentary from officials suggesting essentially the market's functioning healthily, we don't need to intervene. Tell us what we're seeing in JGBs, how investors are responding. Yeah,
it's a huge change, really. If you think back just to a year ago, as Japanese yields were climbing, everyone was getting very nervous in Japan. Even the Bank of Japan were trying to play it down. They were trying to say, don't worry, this is not going to yields are not going to go up too quickly. We're not going to be hiking too fast. Japanese politicians were very angsty. But in the meantime, we've seen wage increases very substantial across Japan. It looks as though this year is going to be another very good year for Japanese workers in terms of getting higher wage increases. And the yield curve continues to steepen. This week we saw 30-year yields in Japan reach the highest level for 19 years. And there we've had Bank of Japan Governor Ueda standing before Parliament this week, much more relaxed than he sounded for a long time. He seems quite unconcerned that Japanese yields are going up quickly. He reckons that is a reflection of the strength of the Japanese economy. So it's actually a good thing, really, that Japan is strong enough to be able to support higher yields now. And it sounds as though, from a Bloomberg story, other members of the Bank of Japan are also fairly, they think it's okay. Yields can be at this level, that's where they should be. So it's a real change from what we were hearing last year, which indicates that the next Bank of Japan interest rate hike probably is not going to be too far away. Traders at the moment have a coin toss for June. But if next week, during the press conference, if Governor Ueda leans quite hawkishly, we could be talking about a rate hike as early as May.
Okay, Mark, we'll be attuned, of course, to the language, the tone, how they sit and what they say, to your point, right, at a BOJ meeting next week. Mark Cranfield, fantastic context there on what is going on and not going on across these markets, right? Just the story that Mark was just referencing there, just to get that out there. The headline reads, multi-strats rare losses testing the appeal of this Trump trade war, right? So you're getting the likes of, you have Citadel and Millennium posting losses, getting forced out of a lot of these crowded trades. The story's not over, certainly, but really some good context on what's happening in that part of the financial world, given just the uncertainty that's just sort of whipsawing us back and forth almost on an hour-to-hour basis. Now, this brief, I guess, ray of sunshine came through overnight for U.S. markets in the form of a soft CPI print, right? One of the very few bright spots there for American markets this year, because so far 2025 has really been about this fading U.S. exceptionalism story, this pivot back, of course, to this resurging Chinese market. In fact, for more now on how hedge funds in Hong Kong are cashing in on this current boom, Alvin Fan, CEO of OP Investment Management, joining us right now. And OPIM is a hedge fund platform and acts as an incubator here for Asian money managers. And Alvin is here with us in our studios. Nice to see you, sir.
Yeah, good to see you. Yeah, great to be here.
Maybe, can you give us a background what you guys do? Just for, I'm not sure if I did you guys justice.
Yeah,
but maybe coming better from you.
That's very accurate. So we help Asian money managers, those who are coming up the emerging space, and expansionary managers who are coming offshore, larger guys from like China, from Japan, Korea, etc., who want to go global. And then we help them sort of bridge that gap as they move into global institutional capital raising. Yeah.
Okay, I want to pick apart because you have this extraordinary insight really into how trends are shifting in the hedge fund space, particularly kind of newer players that are coming in. I want to ask about China.
Sure.
For so long, for so many years, it has seemed like a very painful play. We, of course, have had a big shift in that narrative with DeepSeek. What are you seeing? Are you seeing Asian hedge funds increase or change their willingness to invest in China? How are they approaching the China space?
Yeah, I don't think they have a choice now, more than anything. A lot of the managers, even China managers locally, really, as I think Dave and I talked about earlier, overinterpreted some of the policy. You know what they say, don't fight the Fed? You obviously don't want to fight the regulators as well here in China. A lot of them were trying to do that the last 3 years, and they got caught on the wrong side. But here we are in a space where they literally told the market, we are going to loosen monetary policy, and they even gave a number for us last week. Biggest number in 30 years. I think it's green lights, green flags all around. Yeah.
Yeah, so this was, I think you're referring to the fiscal deficit
number?
That's right. Yeah, there we go. So as far as granular insights, how much new funds are coming to Hong Kong, for example? When did you start seeing these houses come here? And what strategies seem to be popular these days?
Yeah, so last year we were in Miami raising capital, and I'm not going to lie, it was brutal, right? Normally every year we go and we do a roadshow. It's roughly 50 to 60 meetings. Last year we only had 10, and whatever meetings all of last year. Wow. This was that one trip. I'm just saying this is the iConnections event that we go to. And there was only 10. And those that we did have meetings with, you were really just defending the region in general. Turns out what's bad for China is bad for the rest of Asia. And this made it very, very tough, not just for us, but for other China-based asset managers to raise capital. We were telling them this is a generational opportunities to start building your book, right? And some of the medium-sized allocators agreed with us. Fast forward, here we are, markets are up 40, 50% across CSI and Hong Kong. I'm not saying I told you so, but now actually is a great time to start building your book. Whether it's an actively managed long-short or whether it should be a long-only, I think that's up for debate. Other strategies that have been raising capital this year, we launched 2 Korean strategies, engagement managers. Shout out to Life Asset Management and Counterwave. Moving into the new year, there's still some interest in India and a little bit in Japan, but all eyes are on China right now.
I want to pick up on that point. All eyes are on China. Now may have been, and in fact, when you were last in Miami, that may have been a great time to start building your book. But, of course, US investors, there's still this huge psychological block. Even overnight, I was just looking at these comments from Cars and Block saying China's a trade, it's not an investment. You date China, you don't marry China. Yeah. That psychological change, are we starting to see that in US investors yet?
Yeah, absolutely. Absolutely. You have this trifecta quad, even 5 different lineup. The stars are aligning for China. You have great policy. You have the competitors are not doing so great right now, both in the U.S. and Europe. And you have managers who are actually generating returns. The market is moving in your favor. The teams that I'm talking to, in fact, yesterday I was talking to Fountain Cap, Stephen Luck, and we're talking about how, the first leg up, is this sustainable? when you look at the flows southbound and you look at the rotation in local hedge funds, most of the capital going to these names is not yet institutional investors from the U.S. So what we expect is maybe another leg up, and the FOMO really should start to kick in as the fundamentals start to lead the way. Market will catch up as they have been in the last 2 months.
What's the pushback so far?
In terms of?
From, say, U.S. LPs, U.S. asset allocators, for example. What's the most sort of common denominator that you hear so far?
You have to understand LPs have a really tough time when they're talking to their investment committees, right? It's usually a team of 10 to 12 or so, and you have one or two gatekeepers who look after Asia, and when they bring the case back to the IC, they're saying, look, this is a great opportunity, but there's always going to be one or two in the back room who, because of the narrative, are going to say, hey, you know what? Do we really need to have exposure in that region? And that's been the narrative over the last 3 years. But coming into the last 6 months, that's kind of breaking down when you look at the fundamentals, you look at the innovation that's coming out of the region, and prices following as a result. Just last week, you look at BYD raising $4.5 billion. None of it, actually very little of it was from U.S. and Europe. Most of it was from Middle East. I think that's going to trigger some animal spirits, as they say.
Well, I was going to ask you that. How much is the offset coming from Europe and the Middle East?
I'd say about a third right now. It's still not at
about a third of what you would have gotten from the U.S.?
Yes, yes, exactly. Yeah, most of it's still regional. So all the smart money is coming from Singapore, Hong Kong, new generation of family offices coming out of China as well. So we're very excited about this new asset class or this new demographic of allocators here.
You also have an interesting window into how Chinese houses are moving into the offshore space.
Yeah.
What strategies have you seen be successful, and what are they now looking to deploy in this new environment?
Yeah, so we are part of this association called COPFA, the Chinese Overseas Private Funds Association. And it's a group, about 130 members. A lot of them are Chinese managers coming offshore. And so these strategies are a little bit lagging. They used to be primarily focused on China, and now they're kind of expanding or taking the same strategy and expanding it globally. Some of them are doing great. A lot of them are not doing so great because they don't have that experience. But their acumen is picking up, and they are starting to perform. Now, the strategies that we see this year, they're probably going to start to tilt back to China, especially with the market moving in their favor.
What do you find as, and I guess agnostic of how good and experienced these guys are in their original markets, right? And in one case in point, I guess mainland China, how good they are. Agnostic of that, what seem to be the most material, common challenges that they face? The first couple of years here, like what's the common headache that they all run into?
There's two big buckets. Number one is the cost of execution coming offshore is much higher than it is onshore. Okay. Number two, raising capital, a big part of it is a function of articulating your edge. And this is something that institutional investors are very, very focused on. For institutional investors onshore, they can do due diligence very, very easily. And so articulation of that edge also comes relatively easier. Coming offshore, it's a lot more challenging. So what we do at COPFA and at OPIM is help them translate, not from Chinese to English, but translate the language of risk from onshore to offshore. And it's helped a lot of these guys improve a lot.
So what's the cost? Can you put a number to the cost, for example? In other words, is that an additional hurdle rate I have to put on top?
Oh, it's easily 3 times what they would normally pay onshore. Yeah, between your custody costs, your execution technology, data, etc. It's much higher offshore.
Okay.
What is it that the hedge funds that you see, you look after, you chat with? What is it that they're still most cautious about? How are they hedging that?
Yeah, so I think we're now in a space where accumulation phase arguably is over. Okay. We're not where we were a year ago. Having said that, we are ready for another leg up once institutional capital comes in. So what we see as chop in the market, you're seeing with tariff wars, you're seeing with policy, all of this has to work itself out. Now, are we worried about things like demographics or, say, even the real estate market? The economists are, but the allocators are not. The managers are very excited because we're already seeing signs of bottoming out in both the real estate sector and in the demographics. Right, youth unemployment is coming down very, very quickly, and you see year-on-year growth on real estate volumes, upwards of like 20 to 50% in the Tier 1 cities, and then maybe about 15% in the Tier 3 cities.
Quickly, before we lose you, can you put a sort of percentage or a value on how much China exposure in general hedge funds have, and where you expect to be at the end of this year or maybe next year?
Yeah, so I don't have a really good number for that, but it is definitely less than 20% right now, even for regional investors. We're seeing that rotation this week. So some of those of us who have been long a year ago, some of them are taking profit. So you're going to see a little bit of consolidation, but this is a great opportunity to reaccumulate for the next leg up, which most of us from a technical perspective see to be quite aggressive.
Alvin, fantastic to see you. Alvin Fan, let's talk again.
Thank you.
He wears two hats, CEO of OPIM and, of course, founding director also of COPFA. COPFA, all right. It's very difficult to say. But
you managed it.
Let's put a hyphen in between that as well. All right, if you want to read more about that and how Hong Kong markets are performing in the face of U.S. tariffs, you can read this piece by our equities team, in fact, and the title says it all. Hong Kong stock market booms with Wall Street in turmoil on Terminal and also on Bloomberg.com.
And today, still ahead, we're also looking at China's auto sector with HSBC, Qianhai Securities after they raised their price targets for some EV leaders. We'll be getting their forecasts very, very shortly, so stay with us. You're watching The China Show.
Right, welcome back. You guys are just in time here. Just an update here coming throughout this press briefing, ongoing press briefing out of Couche-Tard talking about this. Well, a couple of lines coming through here. They're speaking in Tokyo. They're disappointed at the limited engagement with Seven & I. That said, they will continue to pursue the transaction and may actually be able to enhance that proposal to Seven & I. The proposed clear termination fee for Seven & I. And that there is a path to approval if we have to talk about, of course, the hurdle, potential hurdle in the U.S. here. Let's get more context here on this ongoing boardroom drama. There's marrying, potential marriage. Nicholas Takahashi, our global business reporter, is in Tokyo for us. Yeah, Nick, why did you put these lines into context for us?
Sure thing. Since about half a year ago, Couche-Tard's approach to Seven & I became public, and ever since then, Seven & I's stance has always been that it's better on its own, that it can go alone. And last week, we saw the Japanese company replace its CEO, announce a big buyback plan, and offer up for sale its retail superstore business. The lack of excitement among investors was maybe an indication of two things. One, that these moves to sort of stand on its own and restructure its business independently might not be as convincing as the company had hoped. And also, two, the fact is Couche-Tard's valuation of the company still remains low, arguably low. Now, as you said, Couche-Tard's leadership is speaking across town right now. And while nothing new is happening per se, their leadership is in town to make that case in person, in that Seven & I is in better shape or has a better future under their stewardship.
Nick, I mean, big picture, what are the likely prospects now for this will they, won't they partnership? How likely is it that a deal can get done? And what is a sort of critical pivot, do you think, to getting this to cross the line?
I think it comes down to Seven & I's ability to turn itself around and convincing investors that it's capable of doing so. I mean, we spoke earlier in the day about another big business story happening in Japan with Nissan, where they also installed a new CEO. And I think it's a similar situation where the parallel is that if the company can stand on its own, it needs to prove itself. And if not, investors are gonna make that decision themselves.
Okay, Bloomberg global business reporter Nick Takahashi in Tokyo with the very latest Japanese corporate drama that's playing out and has followed so many of those through with us for this show. There's plenty more ahead. You're watching The China Show. Stay with us. This is Bloomberg. Good morning. You're watching The China Show. Here are some of the top corporate stories that we are following today. Nomura is leaving the Net Zero Banking Alliance as an exodus by Wall Street heavyweights goes global. Nomura says it continues to tailor its approach to evolving decarbonization rules and economic backdrops in different regions. Mitsubishi, UFJ Financial Group and Mizuho are the two remaining Japanese mega banks in the banking industry's largest climate alliance. And Saudi-backed mobile gaming firm Scopely has agreed to buy Niantic's gaming business for $3.5 billion. The deal includes titles like the mobile hits Pokemon Go, Pikmin Bloom, and Monster Hunter Now. Niantic's games business generated more than $1 billion in revenue from 30 million monthly active users last year. Scopely will not acquire Niantic's mapping technology business, which the company's CEO, John Hanke, will helm under the new name Niantic Spatial.
See, that's a place and a situation I want to find myself in right now. Zen in a Japanese garden, just disappearing into the ether. If the garden doesn't do that already for you. Right, it's very quiet across these markets today. We are getting some upside, of course, coming through, and in many cases managing to avoid entering a technical correction, although we're close to that. Oz and Taiwan, of course, case in point. We are in that for the most part across South and Southeast Asia, for example. Malaysia, Thailand, Philippines, Indonesia are seeing some pressure there. An update of these markets coming through right now. This is Bloomberg.
Good morning. You are watching The China Show. It's 11:29 a.m. in Tokyo. Japanese markets about to go on their break. And it's been a relatively muted day. Yeah, just under 1% gains for... Oh, that's so tiny for me. Help me out, Dave. For the Nikkei and for the Tobix there. And, of course... Japanese, sorry, that is teeny tiny.
So that's the yen and that's the 10-year yield.
Sorry, excuse me.
Font size 2.5, guys, come on. There we go. And this comes already on top of all the numbers to the right of the screens and at the bottom of the screens that you don't see on this graph. But I guess to Rebecca's point, we are going into the break. It did seem we were on the break for the most part of the day anyway, so we might not notice a difference, really. It's been
we had a
quiet.
little bit of positive momentum to start the day after that news that came out from the US. But yeah, we haven't really seen this sort of robust reaction.
We have 30 minutes left here in the China Show, so with any luck, we'll get through this show without massive breaking news and just really complete this break, that quiet day that we're on. 0.3% Asia Pacific. S&P futures have since paired a little bit, so we're coming off highs. We're now flat. The soft CPI print, of course, is a big topic of conversation on the macro front. Here, across sector groups, as you can see, we're fairly mixed. The Intel story is actually giving rise to some big moves in the IT and semiconductor space, for example, within the Japanese markets, to mention that. Right. Now, when you look at what's taking place in these Chinese markets, so a massive rebound overnight in the likes of XPeng, for example, that is playing through. In fact, right now, when you look at the boards right now, I think that we have that, guys, if we can. So when you look at the biggest gainers year to date on the Hang Seng, I just talked about this font size 1, on the Hang Seng China Index year to date. So number 1 is XPeng. You go down the list, you have Xiaomi, which is now an automaker, of course, and you have BYD as number 7. And what do you do after a rally like this is the question.
Yeah, well, we can answer that question right now, Dave. Chinese automakers, have gotten this shining start to the year after that extra pump from February sales data. HSBC raising its target prices for a number of Chinese EV makers. Let's bring in Yuqian Ding, head of China Autos Research at HSBC Qianhai Securities. Before we get into the nuts and bolts of some of this, just big picture, what is driving this big set of new estimates, new targets for you?
Yeah, sure. I would say the catchline in the past 1 month is really democratizing the autonomous. So basically, BYD is bringing autonomous driving into the mass range. Previously, autonomous driving software experience mostly available for the car priced above RMB 200K. So it's upscale EVs. BYD post-Chinese New Year is making a huge autonomous driving push into most of its portfolio. Basically, can you imagine? Now, a $11,000 car have auto navigation in the highway and also valet parking. That's what's happening. That's what BYD has been delivering is even the budget and Seagull model. So basically, from now on, autonomous driving is not a luxury; it's now a new baseline. That has been the one of the most important factors that has been driving the space. The consolidation accelerate those who, with the smart EV capabilities and the product cycle, are considered as the winner. Therefore, the exciting rallies you just talked about.
Has that now become, I think, from the perspective of the consumer? I think you mentioned we've gone from autonomous driving in only expensive vehicles. Now it's almost that you have to offer it, otherwise you might just lose that sale. Has it become really a top ask among consumers that the car will need autonomous driving features?
Great question.
Yeah.
I would say the industry-wise, the smart EV penetration breaking 10%. Usually that's a critical point.
Okay.
Every disruptive change we used to witness around 10% is a critical window. If we have more affordable supplies, of course, that's going to help to push the adoption. Of course, according to the third-party survey, a software experience is becoming one of the important factors when consumers consider the EV purchase. So I would say smart EV, autonomous driving really is the game changing now.
To that point about penetration and adoption, where do you think we end up at the end of this year? If we have now crossed that critical 10% threshold, where do you expect we end the year and going into 2026?
Yeah, that's also a great question. I would say if we recap EV penetration, it goes from 10% in 2020 to 50% as we're speaking now. So it only takes less than 5 years to reach that target with mass market supply. We're seeing a similar case being seen here with BYD pushing autonomous driving into the mass market. We expect most of the industry peers would also follow. With more supply, we'll probably get a new round of visibility before around China Shanghai Auto Show, middle of April. More OEM will make their autonomous driving statements, and more supply will push up the penetration for sure.
We are seeing those cycles of penetration adoption get shorter and shorter, particularly when it comes to autos. Are you seeing that too for this space, for autonomous driving?
Yeah, I would say so, because the industry has been going through the EV transition with all the lessons and experience being learned. Time to market would be critical. So consumer mind share is the most critical thing, and the fear of missing out will drive the OEMs to move faster rather than later.
Okay, let's talk about the stock itself, right? So you've raised BYD quite substantially, in fact. So I think from 389 was the previous price target. You're now at 430. Just talk us through, just to geek out a little bit here right now, what goes into that number? In terms of that upgrade, break down the price target for us.
Yeah, sure. So really, the revision up is twofold. Of course, China assets repositioning and also improving investors' risk appetite, also baking into that from a macro support perspective. And also fundamentally, we do believe BYD now stands as with more visibility as an industry consolidation winner. And also the whole autonomous driving push and bring more software value creation in-house could potentially support on the company's pricing point and margin into mid to long run. So that's the fundamental part of the revision we're talking about,
Okay.
We've also seen this big revision on XPeng from $60 to just over $100. What is driving that shift?
Yeah, again, XPeng is also a leading player in terms of the autonomous driving, and they have one of the best and exciting, most exciting product cycle over the year. Every quarter they have the new model to come, and also I would say in the coming couple of days they're going to refresh the G6 and G9 models. So with a strong product cycle coupled with the industry-leading autonomous driving capabilities during the times of the autonomous driving inflection, the stock are getting a lot of support, not just fundamentally, but also the industry-wide support we just talked about. Yeah.
Part also of your analysis is interesting in that because of the rally that's taking place, we now have a better idea, or the changing of the beta for these stocks, for example, right? Higher cost of equity financing, for example. If you could maybe just order for us in terms of like which stock is the most behaved, for example, which one tends to be a little bit more volatile and has a higher beta, in terms of asset allocators trying to figure out which one's the best buy.
Yeah, let's say different risk appetite,
yes.
for sure.
Yes.
So I would
different
say
kinds of stocks.
Yeah, sure. So I think BYD Geely will belong to the more mega cap or matured company making a solid transition category.
Okay.
While XPeng, Li Auto, NIO, these company are relatively high beta asset class, because these company are still at early stage of the development. I would say Li Auto is profitable, but XPeng and NIO are still before break even. So XPeng is on good momentum to sell into potential profitability second half of the year. But I would say, these three emerging makers are more high beta class.
The XPeng story is interesting. Do you think they'll be profitable this year?
Yeah. I was at possibly fourth quarter of this year.
Okay, and sorry, I missed that. And NIO as well.
NIO, our forecast suggests the year after.
The year after.
Yeah.
Okay, it's coming. All right. Yeah, Bex, you have a question.
Yeah, I mean, just sort of taking a bit of a step back here. XPeng, okay, we were talking about flying cars.
Yes.
Essentially, but my question really is, what is the next big catalyst? Is it, so autonomous driving, we're going to see a relatively short cycle per your guidance there. What is the next big catalyst?
So for XPeng, I would say autonomous driving keeps evolving. With more joining the club, the industry, the smart EV as a segment will thriving, and the smart EV company will continue to get more share. Although market give them conviction, but would love to see more data point to continue supporting that. And also, of course, the product cycle. They have a strong product pipeline this year, and more potentially coming next year. So I would still saying in the coming 1 or 2 years, autonomous driving and the product cycle still the things that matters the most.
What about pricing trends? Are you expecting prices to remain subdued, competition, margins? You know, the whole, every time we talk to you, you know, we touch on these things because it's very interesting, the dynamics in this industry.
Yeah, so it's binary. So the pressure would be more seen in ICE segment. So ICE will quickly become more and more challenging in terms of the pricing environment, while EV is sailing into smart EV era. So making the incumbency ICE pricing increasingly more challenging. And among the EV, I would say the pure EV or specific, or we call it mechanical EV makers pricing would also be challenging, because more companies are doing the autonomous driving refresh, such as BYD, at the same price versus the previous version. Right. So that's going to challenging those who couldn't catch up at the moment. Smart EV currently have a better pricing opportunity in the near term, as we see that, because the consumers do prefer software experience, and those who provide that or having a little bit differentiation on the software front do get the pricing advantage versus peers.
How much of a drag is the geopolitical environment here, the shifting supply chains, tariffs and so on? How does that hit, or does it at all, in terms of the speed at which autonomous driving is now able to develop?
Yeah, also a great question. I would say China-US is basically geo-fenced technically and a regulatory perspective in terms of comparing this technology. I would say basically 3 factors, enabling factors, algorithm, computing power, and the data. So the previous 2 factors are no longer the bottleneck. Data is really the frontier. So basically more commercial attractions can basically enable more real-world data collection and support on the software, constant software iteration that are going to further optimize the consumer experiences. So from that perspective, we would say that China is arguably leading in terms of the commerciality and deployment at scale. So for the smart EV companies in China, supply chain perspective, for example, the Auto AD chips, they're both sourcing from NVIDIA and also from local chip provider Horizon Robotics, for example. They are trying to diversify the supply chain. And for the software, we just touched that bit. And more and more OEMs are moving the software value creation in-house.
Final question for you. What's really emerged last year, and I'm wondering if it continues this year is my question, the dominance of local players, without going into names? Do you think local players continue to dominate this market?
Yeah, given the important trend we just discussed in terms of autonomous driving, pushing autonomous driving into mass market, locals are currently leading. So I think it's basically about getting the technology, getting the product right, and those who are doing that right would be the potential winner with more conviction. And at the time we're speaking now, we do see locals are leading in terms of this.
Fantastic. Thank you so much. It was great to speak with you. As always, let's do this again very, very soon. Your PR team here, of course, will help arrange that for us. Right, Yu Chen-ding, their head of China Autos Research at HSBC Qianhai Securities. All right, that's the good news. Some bad news here if you long New Zealand markets. While we were having the conversation, we've now taken out the 10% threshold from the upside back in 2021. That's the record. And we now are, in fact, poised to enter a technical correction on the NZX 50.
But a little bit, I'm going to end on a little bit of positive news before we head to the breaks, which is that Hong Kong is said to be mulling lowering this threshold to buy the most expensive stocks. You can read more about that on the Bloomberg and on web. Stay with us. We'll have more details on that and more stories ahead. This is Bloomberg. Good morning, you're watching The China Show. Welcome back. Here are some of the top corporate stories that we're following today. Alibaba has released a new AI model that it claims can read emotions. The R1 Omni is said to be capable of inferring a person's emotional state from a video and also describe their clothes and environment. It's free for download on the AI development platform Hugging Face as Alibaba seeks to lure users. The Chinese e-commerce giant has recently pushed out new AI tools and apps in a bid to outpace rivals like OpenAI and DeepSeek. Cosmetics retailer Sephora CEO Guillaume Motte is said to have taken personal charge of its operations in China. Sources say it's after the firm's Asia president resigned last year for family reasons. The move is seen as a bid to revive Sephora's sales and market share in China as the firm struggles to win customers on the mainland. And Bloomberg has learned that HSBC is placing some of its investment bankers on short-term retention agreements as it winds down various businesses. It's part of the broad overhaul led by new CEO there, and the plan puts the affected employees on 3 to 6 month work arrangements to finish client mandates across Europe, Asia, and the Americas. The plan also includes cutting vice chair roles in various markets.
Now, AI drug startup Insilico Medicine is actually considering an IPO here in Hong Kong. That's after a firm secured its $110 million US dollars in funding. Now, we spoke with its CEO exclusively earlier here on shows about the details of the funding round and really what the firm intends to do with all that money.
Insilico just raised $110 million, led by Value Partners, one of the largest and respected publicly traded asset managers out of Hong Kong. We got the funding kind of on the footsteps of our phase 2A readout for rintosertib, our lead asset targeting idiopathic pulmonary fibrosis. Phase 2A, meaning that we have demonstrated some safety and efficacy in real patients. The funding is going to be spent on kind of two directions that Insilico is taking. One is we're going to expand our AI platform end-to-end from target discovery, generative chemistry, and clinical trial prediction, all things science and robotics. And we are going to advance our pipeline of more than 30 therapeutic programs in different stages of preclinical and clinical development as far as possible, because our business model relies on software licensing and also asset licensing to big pharmaceutical companies.
Tell us about sort of some of the really more interesting technology that you're sort of investing in using, like a humanoid technology. How does that fit into the broader investment picture?
Sure. So in Insilico, we are trying to focus on cutting-edge technology in multiple areas, not just robotics and automation. As you know, we pioneered generative AI since 2016. published multiple research papers on generative tensorial reinforcement learning in 2019, 2020. So in 2022, we started focusing very heavily on robotic automation in order to very rapidly validate the output of generative AI. Because unlike in any other areas of generative AI where the output can be evaluated by expert humans, in drug discovery, even some of the most expert humans cannot evaluate whether the molecule works or not. So you need to do the experiment. The faster you do the experiment and learn, the better your AI becomes over time. In order for us to fully automate the robotics platform, not only using robotics hands, robotics arms, and autonomous guided vehicles, we have deployed humanoids. As you know, many of the equipment types that are currently being used in the laboratories worldwide are not exactly tailored for automation. Many steps need to be performed by humans, by human hands. So in order for us to fill this gap, we deployed humanoids. And of course, next pandemic hits, we would be able to safely stay at home while our humanoid companions would be able to perform the work.
Alex Javaronkov there, founder and CEO at Insilico Medicine. And if you're a Bloomberg subscriber, you can catch up with all of our interviews by using our interactive function, TV Go. You can also join the conversation by sending us instant messages to our team, questions to guests who come on our live shows. Please do go check it out at TV Go. You're watching The China Show. This is Bloomberg. There's plenty more ahead. Good morning, you're watching The China Show. Now, some breaking news and big news for Hong Kong. Hong Kong's stock exchange potentially mulling lowering the threshold to buy some of its most expensive stocks. It would just open up, essentially, the market to retail investors. So currently that limit is set by companies themselves, and it can range somewhere between having to buy sort of 100 shares to thousands. Yeah, and I think in the case of BYD is a good example because the minimum you currently need to buy BYD is at about, I'll call it even, about $23,000 US, right? So for, entry-level investors, retail investors, that's somewhat out of hand. And really being able to lower the board lot, I think, is the key here. This board lot review was mentioned, in fact, by the financial secretary. So we'll see what happens with this. Details on the story, of course, on your Bloomberg terminal. Right. There's no really good pivot from this. Actually, no, there is. There is. How do you spend less money on something really valuable, like expensive stocks? And of course, today, the Michelin Guide has, of course, released its selection for Hong Kong and Macau of the 10 restaurants where you really don't have to break the bank for to really get good value. And of course, it's subjective, but they have their list here. That was a seamless segue there. But yeah, it is. Look, Hong Kong is such a foodie town, right? This is one of these lists that people do watch for really closely and also debate furiously over. Yes, yes. I mean, this will be no doubt catching the attention of everyone in the industry, plus everyone who have been to these places, right? The industry certainly needs a lot of good news. When you have a look at the data, government data, in fact, on this one, right? So revenues across the board have yet to fully recover. If not, we're not even close to being where we could have been. And that green arrow points you to that direction if the protests didn't happen. And, of course, COVID and all the disruptions taking place. So, I mean, things have picked up from the bottom for sure, but we're certainly nowhere near those levels. Yeah, and it's been a really tough time for the F&B industry. We've also seen the changing makeup. Demands have changed. We've seen some of these sort of high luxury Western names exiting, but we've seen equally really expensive mainland options coming in and entering that sort of high-end market as well. So the makeup of how that landscape looks like in Hong Kong has shifted as well. It's very diverse. Very expensive huo guo, for example, right? Yeah. Very fancy. You have karaoke rooms within, having hot pot. Now, so I guess a nice way to end the show right now is we've actually polled our China team, the China Show team, and this is and by the way, just to make it clear, no endorsements here. This is our list of our go-tos here. And Rebecca, I'm wondering, why did you pick Jollibee? I knew you were going to pin that one on me. You know what? You're not going to tempt me into dragging Jollibee on this show. But I will say that wasn't my pick.
There we go. So have a look at this. You might have your own picks as well. This is our, of course, iteration of our usual haunt here on The China Show.
Your tasty Thursday evening awaits.
There we go. The lunch break, an hour away. For us, it's a minute away. Thank you for joining us today. We'll see you all tomorrow.